All right, we've got lots lined up on the show ahead and just about a couple of minutes to go then for the markets to open up for trade. And do remember, you have the US markets, which were pretty soft in yesterday's trading session. For the most part, Asia as well has been pointing towards a pretty tempered start. And going by the fact that yesterday's trading session as well was rather choppy, we're not going in with very high expectations for trade today. Fifth straight series, though, that we did manage to clock in those positive gains. That has been the second best expiry this year. So whether or not that is going to be replicated, that continues to be monitored. Of course, that disconcerting factor was the fact that we saw a mammoth net sell number on the FIIs, close to 3,900 odd crores, which has been the highest since the month of February. So that is something as well that the street will be taking cognizance of. But we will be watching out for a whole host of individual stocks, ITC in particular, with the kind of fine print that has been delivered on the back of the hotel demerger, the conference call details, the fact that you've got a lot of these oil and gas stocks that will be in the spotlight owing to the fact that you've got the Singapore GRMs that have scaled up. We'll be watching out for Piramal Pharma as well with respect to the rights issue and a whole host of result reactions as well that will be, Aisha, on the markets radar.
Oh, yeah, absolutely. And of course, given that we closed below that 19,700 mark on the expiry, and given how fabulous this series gone by has been, I mean, forget for an instant what happened yesterday or day before. The fact that this is the one series where we've seen historic highs for the index and for the markets at large. The fact that within that sectoral churn as well, the Nifty managed to just fall short of 20 points from hitting that 20K mark. Let's see whether the series ahead can actually, do that magic or not. Pharma and realty have been some of the big sectoral winners as well. And the kind of move that you're seeing, or rather the kind of comeback that you're seeing in the pharma sector as well, is something which is remarkable. The Nifty Pharma Index has managed to gain for a fourth consecutive session. So that's one pocket that we're going to look out for. And interestingly, the news flow as well as earnings as well have been very strong actually from these pharma majors. So that's definitely one space that we're looking out for after that 3.5% gain that the Nifty has seen in the series gone by and the 5% move on the Nifty Bank. Let's see what start of the new series actually has in store for us. Like we've been flagging out, there are stocks umpteen to really look out for. But the only, sort of chink in the armor this morning is that you're not really starting off on the best footing when it comes to the global cues. They're definitely a weak handover. But there you go, the opening bell, the Nifty resilience continues. We are still just hovering around that 19,650 odd level, mildly, very mild, flat kind of start. But let's see, these are early days where we actually pick it up from here. I'm going to check in on what ITC is up to and how the street is absorbing that rose commentary on the sidelines of the hotel demerger. The fact that it's going to rise by 18 to 20% is what the management indicated. 0.5% higher for ITC is where we're currently at. A lot of other earnings which are going to be on our radar. Indian hotels, firstly, the occupancy levels have fallen on a sequential basis. Margins have seen a decline of about 180 basis points. Cost pressures are what you can attribute this to. We're going to be chatting with the management as well shortly. Mildly soft is where Indian hotels has actually kick-started in trade. Now to the positive set of numbers. Ajanta Pharma, margin expansion, EBITDA has risen 22%. Gap up move on Ajanta Pharma, 8% higher, 7% higher is where that stock is. Macrotech Developers as well. Although, the realizations have not quite, matched up to what the street was anticipating, but the pre-sales have actually, shot up about almost 30%. So that's the take coming in from Macro Developers. Also, a couple of other stocks which are going to be on our radar as well this morning. Let's quickly bring up that list. Impressive numbers coming in from BEL as well. The EBITDA jump up of 29.4%. New order wins are now at a record high. 3% higher is where you're currently at for BEL as we speak. bunch of other stocks that we are keeping on our radar this morning. There's Piramal Pharma as well. The rights issue has been priced at 81 rupees per share. Let's see how Piramal Pharma is reacting to that particular news flow. The ratio has been frozen in at 5:46. Piramal Pharma currently lower by about 2% as we speak. Also very good numbers from Home First Finance as well. The revenue from operations stand at about 255 odd crore rupees. That's an uptick of 50% on a year-on-year basis. Home First, mildly tempered, but maybe you will eventually see a pickup in this stock. Sona BLW, we're going to be chatting with the management as well shortly. The margins have seen an uptick. The revenues have risen. 25.25% is what they've clocked. 599 on that stock. Sham Metallics as well. The board has approved a fundraise of 3,600 crore rupees. Revenue uptick 2.6%. Indus Towers, Intellect Design, they're all positive set of numbers. Let's see where Indian Hotels is now settled in at, given that the numbers weren't at par with what the street was anticipating. There's also JK Lakshmi, which has come out with the numbers. The results are below what the street was anticipating. Net profit has come in lower by 26%. And since we're talking about earnings reactions, I definitely want to see where Laurus Labs is finally settled in at. After the stock really being all over the place post its numbers came out, the recovery on the back of the management commentary continues on Laurus, holding up 0.5% as we speak right now. Trident, LG Balakrishnan, Sagar Cements, they've all come out with a disappointing set of numbers. So not bad at all. It's a quiet start, and amidst the global cues, Kunal, one would have to say it's a resilient start as well.
Yeah, it's a resilient start, and even at the open, there are a lot of things to adjust. That 140-point premium for the index for the start of the August series. So the initial gap down opening is part of a process to adjust the steep premium for the August future. So I would expect that once that settles up in the next half an hour, next 1 hour, is where the real trends would emerge for the index. And the put call ratio was extremely oversold for the index yesterday. So hopefully that should now act as a support point for the index on an intraday basis. The stock which I would look to trade in the open would be on the sell side, and that will be on Ashok Leyland. That's a stock which I believe is heading towards some sort of a resistance or a hurdle zone at the 180 to 83 mark. So that's a stock which I would look to trade in the open.
Okay, let's find out what Vaishali's views are on the market open rates at around 19,600. What's the take given that it's flat across the board, Vaishali? And what's the first trade that you're punching in this morning?
So, well, I would say that market is holding on. So I would still wait and watch for another 15 minutes. But, well, it continues to be a hold. And as far as Ashok Leyland is concerned, I have a contrarian view. I would say that, yes, the upside target is still open for 190 levels. So I would say buy it with a stop loss of 175. So that is where we differ. But, yes, I have a buy on Ashok Leyland.
All right, that's the view coming in. It's a buy recommendation on Ashok Leyland. All right, let's bring on board then our next guest to talk about the view ahead for the equity markets. Vikas Khemani is founder at Carnelian Capital Advisors and joins in live. Hi there, Vikas. Thanks so much for taking time out. What's the general view on the market at the current juncture? We had that almost touch and go moment with 20K. We've retreated. The earnings now pretty much seem to be out of the way. Macros are looking fairly decent. What does that spell out for our own markets?
I think broadly things are working out very well. Earnings season has passed, with a reasonably good output, and liquidity continues to remain robust. So, of course, whenever market rises very sharply, it is bound to get into a narrow consolidation zone, which I think is going to be around in and around here, and maybe a little bit of correction as a part of normal market correction. But in general, I think we are optimistic about market. From a medium-term to long-term perspective. Of course, there are some pockets of exuberance in mid and small cap space, but one has to be careful and avoid those risks. Otherwise, in general, I don't see any major risks to the markets. I think broadly things are in place. Earnings season is continuing. The economic growth is fine. With next year election season, I think spending in the economy will increase. So broadly, I think things are chugging along well, and I think markets are looking pretty decent.
Because that's exactly what I want to talk about, right? Because while no one is looking at exiting the market, no one thinks that it's heating up yet. The indicators don't seem to be suggesting so. But within the market, where do you think are pockets of overvalue and undervalue right now?
I always believe that whenever a lot of people are chasing a particular theme or a particular segment, you are bound to see some amount of exuberance or euphoria in there. And small and mid cap space in general, I have seen bit of a stretched participation and stretched valuation. Again, I won't broad brush everything, but there are pockets where within that one has to be careful. In a markets like this, typically, less quality also ends up doing well, and that is where people fall into trap. So I think that is one should always be warned about. In a bull market, quality of the portfolio deteriorates, and one should be very careful about that. Secondly, things like defense and all, according to me, are while it's a structurally long-term good opportunity, but bit stretched from all point of view. In general, at least our approach has been to be a lot more careful about what you're participating. We are looking and finding ideas and companies and segments where nobody wants to look at, but the structural growth drivers are still intact. I will take you last year. Nobody wanted to buy IT, and everybody had a negative about IT. And you see how IT in last 3 to 6 months have done, especially the mid cap IT. So always, you have to look at something which is the differentiated approach, and where markets are not looking, and where there's euphoria is something what one should avoid.
Vikas, you made a very interesting point about defense and how it's, top on everyone's radar along with many other sectors which we'll discuss. But what I find interesting is, and considering this is declared data, so maybe we can talk about it, as to how within defense you're now digging out and scouting out for ancillaries. And I'm talking about, an unlisted company that you actually made investment in your structural fund, Aeroflex Industries. Quite the interesting business model and an ancillary to the larger defense theme.
Not really. I don't think that's. While I would avoid, speaking about the stock. It's not a defense ancillary. It is definitely part of the theme where we are playing China plus one, where it is, it's 80% export kind of business. So it's a part of the China plus one and manufacturing theme, and that continues to remain very, very robust. Idea is this theme is here to stay for next 10 years, and if you can identify and get into companies which are solid, robust, and stay into them, in my opinion, multi-baggers would come out of that. So that has been our approach for last many years, and we continue to follow that approach. Wherever there is an exuberance, we would stay away.
I stand corrected. Defense is one of many things that, or rather many industries that they cater to. Aviation, space, semiconductors, EVs, oil and gas, chemicals, they cater to a large gamut of the industry. Vikas, you talked about mid-cap IT. Tell me what's actually stood out for you. And, just IT as a theme at large. Do you think that in terms of the commentary that we've heard from the management, there have been some shockers as well, right? Be it a TechChem or in Infosys with the kind of guidance slash that we've heard from them. Do you think we're at the fag end of the worst news or there's more to come?
First of all, I think you must understand most IT stocks have done well. So, let's not in last, 3 to 6 months, specifically after the fall last year. I think barring one or two companies, which I think are more local issues, like Tech Mahindra has had a change of CEO, so a bit of, I would think that there's a kitchen sinking has happened, and there's a transformation, in the play. Infosys has its own challenge in terms of a lot of leadership leaving. So, in general, we are not, negative on IT. We are positive on IT. We think IT is a very good trade on interest rates coming down in US. And right now, most companies are winning contracts for the survival spend. Growth spend is yet to come. Development spend is yet to come. And that would happen only once the environment settles down globally. Worries about recession, potential recession goes down. Then I think CEOs would, sort of loosen their purse and spend more on the development and growth part. So we think it's nothing to worry, and especially in the mid and small cap IT space, we have seen companies like Cyient, Birlasoft, and Persistent, and many of them have continued to deliver superior returns, superior results, and continue to guide well. For the simple reason, A, they have a low base, and plus each of them have their own strategy and segment to target. I mean, ER&D space is growing very, very well. So if aviation is growing very well. So you don't have to, sort of invest IT in general, but you have to invest into stock within the sector. And that is where we always think slightly different according to us. We continue to remain quite positive on IT.
What about the view when it comes to banks? Do you think that it will continue to remain a compounding story in this market?
Absolutely. I think, if you see Indian economy is going to do from $3 to $5 trillion, banking is one of the largest sector which will lead it, right? Good part is that in banking, our balance sheets are one of the best ever. Growth is coming, in a reasonably good proportion. Investment cycle has just picked up. So you have both triggers of investment cycle as well as the retail credit growing, which is a very robust, a good situation. So you have diversified growth coming on the asset side, and your balance sheets are very well in place. And given what we have, the credit infrastructure in place in form of IBC and CIBIL score, I feel that there is a structural repair which has happened to the sector. I mean, we wrote a note on this about a year ago. So with this structural repair, I think the worry of NPA cycle, in that proportion, what we saw last cycle would not be there. So to that extent, I feel that this sector can deliver anywhere between 15 to 20% return compounding over next 5-6 years as long as the economic growth continues. Within that, there will be ups and downs and cycles. I'm not saying that, but structurally speaking, this sector is very well in good shape, and can deliver good compounding ahead.
Okay. What's the outlook then on the entire space, and how you're looking at companies such as an Industar Capital, and a Salzer Electronics as well? If you could just give us a little bit more clarity as to why the space is looking appealing.
Not really. I would not probably want to comment on any of the stock holding per se. Generally, we look to invest into companies where we can see a good earnings growth as well as the re-rating. And some of the names you mentioned, where we call in our internal parlance magic basket stories, where we think that they can get re-rated based on our own analysis. All I can comment is on that. But generally speaking, I mean, each stock has a lot of investment thesis, which I would probably stay away from commenting because of the compliance reasons.
All right, fair enough. I won't really probe on that. But, given the fact that we've seen Vikas Autos really have a pretty stellar year gone by, and expectations as well were riding very high when it came to the quarterly numbers, do you think that, it has the strength to continue its up move, given that a lot of the supply chain semiconductor issues as well seem to be behind?
Absolutely. I think auto sector has been growing. We've been overweight on auto sector for some time. If you see between 2016 to almost 2022, there was hardly any growth in the auto sector, right? Pent-up demand has been there. Infrastructure has been building. Economy has been growing. So obviously, it is bound to, happen that you will see accelerated growth once all the issues are sorted out. Like you mentioned earlier, IL&FS crisis took away the credit. Then pandemic happened, then semiconductor chip kind of impacted the supply side. So all those things are behind, and we think auto sector can do well. Demand is robust, so and associated and auto ancillaries also will do well. So the whole pack looks pretty decent.
Vikas, great to have you on the show. We'll let you go on that note. Good to chat with you as always and get in get into probe you a little bit more about what your market thesis is right now. Quickly revisit what the market's rates have settled in at. We're 80 points lower, 19,700 holding for now at least on the Nifty futures, start of the brand new series. Delta Corp, Sun TV, BEL, RBL Bank, Indiabulls Housing, these are your big buzzers in trade. But the biggest buzzer of them all has got to be Laurus Labs. Firstly, that sharp drop in the reaction in the stock price after the numbers came out and the margins were such a big miss, and then the sharp recovery as soon as the management hinted that they're going to be maintaining their FY24 guidance and very positive outlook ahead. So let me welcome on board Dr. Satyanarayan Shava, the founder and CEO at Laurus Labs, joining in on the show right now to talk about what the prospects are going forward. Dr. Shava, great to have you today on ET Now. Thank you so much for taking the time out. First, let's address the bad news, because during your last earnings call in the month of May, you assured investors that your margins will not go below 20 to 21%. but now at 14%, is what you've clocked. What were the reasons in the quarter gone by for this kind of a sharp fall?
See, the first we have to consider the margins for the revenue what we have done. We maintained margin levels around 50%, similar to Q4 FY23. When sales were down, all our EBITDA numbers and PBT PAT are down. We have orders, but the shipments were moved to Q2 from Q1, so our revenue was less in Q1. But otherwise, our market share in the products where we are operating is pretty consistent. So internally, we have no concern. We clock less revenues in Q1. That's the number what we had in mind when we started the financial year. So it is not a surprise for us. We are doing as per our internal plan, and we are confident to get back to normal levels very soon.
Normal levels in the second quarter, do you hope to get back to that 20-21% kind of band?
Yes, definitely yes.
Okay, great. Also tell me, what's giving you confidence to you? Because, like I just highlighted before we welcomed you on board, the kind of guidance that you've actually given out, that's something that's, really impressed the street. What gives you this kind of confidence on the recovery of ARV, which is now much awaited by the investors as well?
The ARV is very critical part of our business, but that is not going to be critical part for our growth. So we maintain our ARV leadership position in both APIs and formulations. The global fund order started kicking in from Q2 onwards. So we have a very good order book for Q2. And our ARV APIs, we are almost consistently doing about 400 crores per. Last quarter we did 400. This quarter I'm sure we will do same number, if not more. So ARV will become stable from Q2 onwards. APIs will do similar number, but formulation will do bigger than what we did in Q1. In Q1 we did about 190 crores ARVs. And this quarter looks bigger than that. And other CMO, other oncology products, we have a very good order book right now. So the confidence in Q2 is coming from our order book, what we have in our hand.
Some more details. You talked about margins and why they were hit in the first quarter, but the numbers have been missed on all counts, right? PAT as well as revenue as well. What do you think is going to be firing all engines in the future quarters to come for you? And why such a big drop in the quarter gone by?
You are comparing the quarter FY24 with FY23 first quarter. In the first quarter of FY23, we did execute a large POs for a big pharma. So there is a bulk of supplies went in that quarter. But we have very good product projects from big pharma at various stages of implementation. And we also have signed a contract for a long-term contract for a crop science company. Our animal health facility was inaugurated in June. So there are a lot of positives in the organization. But you also need to keep the diversification efforts what are being done by the organization. We are moving away from being an ARV company to well-diversified organization. So in the previous years, our 2018, if you compare, 73% revenues came from ARVs, both APIs and formulation. Last year, only 37% of revenues came from ARV, APIs and formulation. Actually, we gained about 600 crore more revenue from FY18 to FY23. While we increased our ARV revenues, we were able to decrease the contribution from ARV significantly. So those efforts are yielding the benefit, yielding the growth. In fact, our growth drivers in the future will be non-ARV, both APIs, formulations, and also predominantly from CDM.
Morning. Now for the CDMO business, there's human health, animal health, agrochemicals, etc. in terms of verticals. Can you walk us through the margin profile for each of these?
See, in the case of animal health, we have a basket of products which are underpaid, which are in clinical phase, which are genericized. So margin profile is no different from human health here, very similar. And in the crop science chemicals, we are not looking at one step, two chemical step, thousands of tons crop science chemicals. We're looking at complex chemicals where there is a chemistry skills are involved, biocatalysis or hydrogenations are involved. We are looking at those kind of crop science chemicals. So our margin profile will be, we believe, will be very similar in any of the segments in.
Okay, fair enough. And you've also signed a contract with a company for agrochemical CDMO. What are the details on this?
We did supply registration batches last year, and we are about to set up a commercial plant for them, and supplies will start end of next calendar year, right, 2024. And because of our ability to execute projects both at R&D and also commercial scale, we are about to sign another project with the same customer, and we are talking to a few other customers on the ag space. That's also looking interesting. As I mentioned, I don't mind repeating it. Our focus on agrochemicals, crop science chemicals, is complex ones. We are not doing 10,000 tons, 20,000 tons, but we are not looking at.
Dr. Shafa, you also have a very high capex plan and at the same time have high debt guidance as well, right? As I understand, and please correct me if I'm wrong here, your current net debt leverage is already at 1.6. How do you plan to tackle this, and do you think you're going to be generating positive cash flows in FY25?
Definitely, yes. See, this year and last year, our capex intensity was higher because of our commitment to deliver batches, validation batches at the commercial scale. We set up huge capacity. And even look at our annual facility, we invested in the entire site we are building. And each block will go into commercial at different times, Q4, Q3 one block, and Q4 one block, and then Q1 next financial year another block. So these capexes are well spread. So we don't expect to use capex in the next financial year. But if there is a need, customers are willing to do projects, we don't mind spending capex. See, if you look at our return ratios are much above the debt burden or interest burden for us.
All right, thank you so much for taking time out and joining in and giving us that view on how business is shaping up for Laurus Labs. Well, let's move right on then and connect with Vivek Vikram Singh. He's the Managing Director and Group CEO at Sona BLW Precision. It's been nothing short of a pretty healthy quarter, particularly when it comes to the quarterly EBITDA performance. Let's get in more details then, and thanks so much for joining in. To begin with, it has been a good set of numbers delivered. What has led to this? And the more important question is, at these margins, 27.6%, do they seem sustainable down the line?
Thank you and good morning for having me here. Look, for the last, I would say, 20 odd years that we've been in existence, our margins have ranged between 25 to 27%. Since we've been listed also, it's been in this range, and we expect that it will continue to be in this range for the foreseeable future.
Okay, fair enough. So what is going to drive those margins? Can you give us a little bit more clarity? What will be the key growth drivers for these margins that will sustain at these levels?
Yeah, so actually our margins have higher. They were 28 point something. They dipped in the middle when the commodity prices rose inordinately. And with better product mix and better operating leverage, they have come back to where they were. So it's not a question. I mean, we have sustained it for 22 years. Hence, we expect to sustain it even further. The growth in EBITDA in absolute terms, that's what we as a company strive for, because to increase the profit pool, to increase the cash flow pool, that's our objective. That also we've done fairly well. I'd say we've been growing at a 30% odd CAGR for the last 8-9 years. That comes from identifying the right market segments in the auto industry. For example, electrification. We've done quite well on that. Adding new products, adding new product/market segments, and continuing on that journey. So I think 2 years ago, when I came after my IPO for the interview, we were about a 1,500 odd crore company. We used to do less than 500 per quarter. Now we do 700 plus per quarter every year. So yeah, the growth is basically on those three things: identifying the right trends, getting into the right market segments, and developing new products all the time. That's basically it.
And I guess, Vivek, that's why the capacity expansion at Chennai as well, right? Tell me, how's this managed to boost your financials? Has it added in the first quarter?
Not really. So EV two-wheeler, Aisha, you've seen what happened with the FAME 2 subsidy withdrawal. So it's been a bit of a hit. Actually, that's one of the things we led with in this earnings call last evening, that we believe in leading with bad news, because when talking to shareholders, bad news should take the elevator. And we did take a 25 crore odd hit in the first quarter. It should have been, I know the growth is fairly decent, 24% revenue, 43% EBITDA, but it had been higher. It would have been much higher, barring this. Still, despite this temporary setback, we are adding our traction motor capacity because, one, we have won a lot more new programs with a lot more new customers. And this two-wheeler, three-wheeler segment will electrify with or without subsidies. That's our belief. So that's where the capex is going. If you did notice, the fine print is for PCBAs as well as the motor capacity. The PCBA is because, you know, we have to set up our own SMT lines. We can't be buying power electronics from Taiwan or outside forever. So we believe in getting manufacturing of higher value components in-house, which is what we're trying to do with this capex.
So, you know, Vivek, let's take a step back. And given the, you know, one-off hits that you've seen in the first quarter, tell me what's the good and what's the bad for both Q2 as well as the full year?
The bad, I would say, is the EV two-wheeler market segment. We still don't know, although July, from the data I've seen till date, seems decent. It isn't back to the highs of let's say 4-5 months ago. So let's see what this impact is. I think it's too early to tell. But as you know, in the scooter segment, 5 to 10,000 or 15,000 price increase will have an impact. So that's the bad. But despite being conservative, I can't think of much more bad. That is the only bad that I can see right now. US market's looking very good. The European market has recovered phenomenally. Last year, this time, Q1, our revenue from Europe had dipped to just 11% of our revenue. So it's gone back to 23% where it used to be historically. India is looking fairly decent too. So yeah, I wish I could help you with more bad news, but there isn't much, to be honest. Apart from that regulatory shock on EV two-wheelers, everything else is much better than it has been in the last 3 years.
Digging for more bad news, don't get me wrong there. But since you did talk about Europe, right, Vivek, I just want to say, I mean, can one take that on record that perhaps the worst is behind you when it comes to the Europe business?
I think so. I mean, there were two issues fundamentally. It wasn't an issue at our level or at our customer level. And I think there was a supply chain issue which did not let the pent-up demand be addressed properly. And for 2.5 years, that persisted. So even with higher interest rates, not as strong economic background in Europe as we would have hoped for, I think still just this factor may be good enough to tide us over for the next 12 to 15 months. Medium term, let's see. I mean, European economic recovery is something we will all be watching for. And much brighter minds than mine are on this problem to see if Europe will get into that recession or not. And consensus seems to be now turning that we may not have a recession. So let's see.
Certainly. Now, Vivek, you've also added the high voltage traction motors and inverters to the product offerings, and as well as took up an order for, the OHVs. What kind of revenue potential do you see here?
So I'll be frank, Avni, we don't calculate TAM for these things. The market is large enough. We have a product proposition that is a winning proposition. It has the best power density in the world for the bus category. India is the second largest bus market. There are large bus markets in Southeast Asia as well. If we can capture even a fraction of this opportunity, it will be big enough and meaningful enough for us. And hence, we are okay to go with that. And that's how we operate. I mean, if you read the book Innovator's Dilemma by Clayton Christensen, this is what it talks about, that big companies often spend too much time in valuing the size of opportunity. And any new market segment, the size of the opportunity initially is small. So if we had gone by this logic in 2016 when we entered passenger vehicle electric segment, it was so tiny that by any normal logic, we shouldn't have done it. But we did it because it was a meaningful innovation. It was a great product and we had the winning formula. We are following the same approach even now. So we are not trying to value the opportunity. We will see if we have a right to win, we will succeed.
Enough. I get your point there, but what about some of your other ongoing projects? How many of them are currently in the ramp-up stage? How many are yet to go on stream? What's the latest update here?
Yeah, quite a few are actually now active. So if you look at our EV project portfolio, I think 23 are now active. 3 more entered production this quarter. 2 from traction motors, 1 for a 3-wheeler, 1 for an established 2-wheeler player, and 1 driveline or gear program for an electric tractor. So yeah, a lot of interesting things going on and a lot of active projects. We also won 4 new projects which will start either later this year or next year. So exciting times, a lot of new things are happening. I mean, I don't think 5 years ago any one of us would have thought that we'll see electric tractors ever. And to make parts for them is fairly exciting.
And considering you make for all, right, Vivek, I want to really talk to you about where do you see the prospect of future of auto industry? I mean, who knows, soon we could be making in India Tesla cars and selling here as well. And all the innovation which is happening in the two-wheeler space, just so many tie-ups we've heard from Hero MotoCorp, Bajaj coming up and entering the 250cc segment, giving Eicher a run for their money. Who knows? Tell me, where is the auto industry headed next? I mean, what's your vision for the next 5 years, considering all the changes are happening in this one sector alone?
True. So Aisha, you actually captured it rightly. I think more has happened in the last 5 years in the automotive industry than it happened in the last 25. I mean, if you look at the industry, after the automatic transmission, and that was, I think, 1970s, nothing has happened in the auto industry that can be said to be truly innovative. But in the last 10 years, with the changing of the powertrain and going electric, along with the increasing intelligence in vehicles, the autonomy, the self-driving concepts, so many things that you would do with your own hand. I mean, I remember when as a kid, I used to roll down the window myself, right? With your own hand, you used to do that. When I actually remember the old Willys Jeep, which used to be cranked with a crank manually. It has progressed so much more in the 10 years. 5 years, I think, Aisha, is less. We expect too much in any industry to happen in 5 years, and I think we overestimate what will happen in 5. We underestimate what happens in 15. So what we're trying to do is look at 15 years. We believe in 15 years, 90% of mobility will be electrified. It will be an electric powertrain. We also believe that level 3 autonomy should be there in almost all vehicles. And that's the vision we are working towards. India lags the global market. It used to lag by a lot, 5 to 7 years. Now it lags by 2 to 3 years. And we also believe that the lag between India and global markets in technology will keep coming down as we see a newer and more aspirational Indians. we Indians as a consuming class are demanding more and better safety and convenience features in their vehicles. Hence, I think the industry, if it doesn't evolve, they will be forced to evolve to cater to those tastes. So yeah, I mean, I would say this is one industry that one must watch out for. And this is the only industry that can create a higher share of manufacturing GDP, a higher share of manufacturing-led jobs that provide a dignified means of living to a great portion of the middle class. So I would say the auto industry in India and globally is going to be something to watch out for.
And technology is going to be where the battle is going to be fought. But Vivek, great to have you on the show. Avan, only for better roads now in monsoons, right?
Yeah, exactly.
Yeah.
Okay, one can only hope. Thanks very much for joining in, Vivek. Good to have you on ET Now. All right, just a quick glance at the market before I take it to our next guest, and it's at 19,653 thereabouts. The broader markets, mild degree of outperformance is what you're seeing. That attempt to scale up is evident with names from the frontliners like DRL, Reliance Industries, HUL, Cipla, as well as Eicher Motors holding out in the green. Moving on then, it's been a pretty strong set of operational numbers when it comes to Coromandel International. Let's talk about their growth roadmap as well as international capex plans. We've got Jayashree Satkopan, who is the President Corporate and CFO of the company. Thanks much for joining in on ET Now. Now, despite the fact that we've seen a delayed monsoon that impacted sowing, the fertilizer segment has seen fairly decent growth. What would you say that this growth has been volume driven or value based?
Good morning. The fertilizer segment has registered a good volume growth of almost 12% between the NPKs and the DAP for the quarter. You would see that there has also been a moderation in the value growth. That's primarily driven by the lower raw material prices, which consequently has resulted in a subsidy moderation from the government. So the growth for the first quarter is primarily volume driven, which has been good.
Okay, growth has been volume driven. What about your margin? Because on a Q-on-Q basis, that has also seen a good improvement. Can that be attributed purely to seasonality, or have there been other factors at play? And where do you see margins headed?
No, the margins have multiple reasons. As you would note that the raw material prices globally have softened. The operational efficiencies have picked up. The plants have operated almost at full capacity. All of these have contributed to an increase in the margin for the first quarter.
What about the outlook on how you're managing inventory of raw materials, given the fact that we have seen falling prices, because the street was expecting an inventory loss?
So knowing that the raw material prices have been coming down over the past few months, Coromandel has been looking into the inventory management very carefully. Therefore, we were not holding too much of inventory, and with the multiple sources that we have, we've been able to manage inventory on a more or less just-in-time basis. So that has actually helped in terms of our raw materials. As far as the finished goods is concerned, the POS liquidation has been a little soft in the first quarter, rightfully so, because the monsoons have also been slightly delayed. However, there is a lot of action that is happening on the ground along with the agronomist and the sales team to see that there is liquidation of the fertilizers in the market as the monsoon picks up.
Sure. Ms. Jayashree also wanted to talk about, crop protection as a segment. The performance was affected during the quarter clearly. Any strategies then to counter these challenges now? Because as we understand, you've also acquired this, 50 acres of land at Dahej as well. Will that be utilized for crop protection?
Yeah, the crop protection business had faced some challenges. This is primarily due to the macro industry challenges and headwinds that the agrochemical industry has been facing over the last couple of quarters. Be it the softer markets globally, the raw material prices that have come down sharply, and some amount of dumping that's been happening from China. And in India, we've also seen that the monsoons have been delayed by a couple of weeks. And therefore, this particular segment has seen a softer quarter. Having said that, there are multiple actions that we are working on in the crop protection segment. One is to diversify the portfolio, which means we are looking into far more newer technicals to come in compared to the earlier generics that we are manufacturing today. Part of it is also to look into additional land and new multipurpose plants to come in. So the 50-acre land that has been procured in Dahej is primarily for crop protection chemicals, where we will be housing a herbicide multipurpose plant in the coming quarters. Similarly, there is also a diversification plan using the existing assets, infrastructure, chemistries of crop protection chemicals to move into specialty chemicals. So that is also progressing well. The third aspect on the crop protection side is a foray into CDMO, which offers a large opportunity to serve global MNCs. Here also we have seen very positive interaction and traction from the global customers. So these are some of the strategies apart from looking into pockets where we can improve our operational efficiency, sales efficiency, so on and so forth.
You know, as we understand, you had also announced to invest about 2,000 crore rupees out of the 1,000 crore rupees into the CDMO space, right? Specialty industry chemicals within crop protection business. Tell me, how's that coming along? And what is the gestation period before we actually see some revenue visibility?
Yeah, the 1,000 crore of investment that was announced for crop protection chemicals was primarily for the multi-purpose plants in CPC, and to a very small extent for the specialty chemicals in this whole scheme of things. For CDMO, there could be additional investments as we firm up the contracts with the global multinationals. As far as the 1,000 crore investments in the multipurpose plant is concerned, the first and foremost is acquisition of land that has got completed. There are 2 or 3 proposals for the multipurpose plant. One is for the herbicide plant that is likely to come up at Dahej in the newly acquired land. Another one which is on the multipurpose fungicide plant, which is likely to come up in Ankleshwar, where the proposal is in the final stages of approval. Similarly, the business is also looking into one more multipurpose plant that would come in Dahej in our existing facility itself for a couple of molecules. So all of these are in the stages of internal approvals, and typically to set up a large plant, the timeline is about 18 to 24 months. So in about a couple of years, we should see revenue tracking from all of these new plants that will be operational. Having said that, even in the existing plants, there are opportunities to see how it can be repurposed without much of capital expenditure. And that is what is currently being pursued, which will help us to get some revenues through a launch MPP, for instance, or by modifying some of the infrastructure, getting into customers in the specialty chemical space.
Sure. Great to have you then today on the show. Thank you so much for highlighting your earnings.
Thank you.
Okay, let's take a very quick break with news that we seem to have stabilized, mildly soft in trade, and we continue to be so. RBL Bank, that's seeing a big recovery today, 4.5% higher. Let's see what M&M is also up to after that 7% slash. A big recovery coming in on M&M intraday graph as well. About 1.25% is the move that you're seeing on M&M. Adani Enterprise is going very strong. Reliance is holding out very well. A 1.25% move on Reliance Industries as well, and clearly that's what's cushioning the index as we speak right now. Let's now move on. Macrotech Developers, Abhishek Lodha, the MD and CEO, joins in on the show right now to talk about how their quarter was and what it's likely to be going forward as well. Abhishek, great to have you today on ET Now, and I'm just looking at your numbers, Abhishek. Despite first quarter being seasonally weak, you've actually recorded good pre-sales performance. Do you expect this kind of momentum to sustain or even accelerate perhaps for the rest of the year?
Yes, we believe that Indian housing is at the start of a long-term, up to 15 plus year cycle, and we are only in year 3. And the housing market size in India is only now starting to become what it should be, but there's a long way to go in terms of sales growth and volume growth. We think affordability in India is good, And if price rises remain below wage growth, then affordability will keep getting better, and that in turn will unleash even further volume growth. So we do, while of course Q1 and also Q2 are typically the seasonally weaker quarters of the year because of summer vacations, then heavy monsoons in parts of India, in addition to and then we have the Pitru Paksh or the Shraddh period. But in spite of that, Q1 has been very strong in terms of performance for us. We had sales growth of about 17%, and we expect this momentum to sustain for several quarters now.
Right, Abhishek, while the pre-sales have been healthy, revenue recognition has taken a bit of a hit in Q1. Have there been delays in execution or deliveries, and how do you expect things to, stabilize or pan out going ahead?
See, revenue recognition in India has two options. One is the project completion method and the percentage completion method. The second is the percentage completion method. We have so far been following the project completion method, and therefore for the projects which completed in Q1 of 2024, you have to look at starts back by about 3 to 4 years. And as you know, in 2020 and 2021, due to COVID, there were very limited number of new starts. So it is automatically implied that the revenue recognition will be weak on account of the limited number of starts which happened at that point in time. However, that has nothing really to do with the underlying profitability or the business strength. And therefore, we have guided all our stakeholders to look at the metrics of our pre-sales and the embedded EBITDA of our pre-sales while judging the underlying profitability of the business. Our pre-sales were about 3,350 crores, and our embedded EBITDA for those pre-sales was at about 30%, which are both very healthy levels and in line with our guidance at the start of the year. Having said that, we are now for sales done after 1st April 2023, moving towards what is the progressive or percentage of completion methodology of accounting revenue recognition, so that there is a closer linkage between the actual operating performance and our accounting P&L. This procedure takes some time because you have a lag effect of sales done prior to 1st April 23. But all in all, over the next 4 to 8 quarters, you will start seeing our P&L becoming much more reflective of our actual performance compared to what it is right now, due to the accounting challenges that are there with the project completion methodology and the limited number of starts which happened in 2020 and 2021 on account of COVID.
Right, Abhishek, as against the guidance of 14,500 crore rupees pre-sales, you've recorded pre-sales of 3,300 crores. Also, you're expecting a strong performance in the second half versus first half. Given this, would you then be looking to revisit your guidance?
So, when we give our guidance, we of course take into account the seasonality of the business. Q1 performance has been good. However, at this point, we do not see, where we would like to wait before we do any revision of guidance. And we are sticking to our guidance of pre-sales growth of 20%, going from 12,000 crores of pre-sales to about 14,500 crores of pre-sales, with underlying EBITDA margin of about 30%.
So given the growth that you've already outlined, can you tell us how much is going to be led by volume and how much by price realizations? And what's the pricing trend that you expect to see in FY24, given the demand and supply dynamics?
Sure. So we expect of our 20% growth, about 6 to 7% to come from pricing. We like pricing growth to be at reasonable levels, and it should be below the wage growth. As you know, the wage growth for a typical homeowner is about 9 to 10% now. So we like pricing growth to be below wage growth, so that there is an increase in affordability and more people can afford and more families can afford to buy a grade A quality home. So we are guiding to price growth of about 6 to 7%. The balance, about 13-14%, will come from volume growth. Out of that volume growth, about 3 to 4% volume growth comes from existing projects, and the balance 9 to 10% comes from new projects. So that's the composition of our sales growth: 6 to 7% from pricing, 3 to 4% volume growth in existing projects, and 9 to 10% volume additions coming from new projects or new launches.
Right, Abhishek, you earlier outlined construction expenses, right, of 500 crore rupees for FY24. With the guided operating cash flows of 6,000 crores, you would have 2,500 crore rupees worth of leeway to reduce your debt. Given this, do you think the debt reduction would be much below the targets you've conveyed?
We are looking at operating cash flow generation of about 6,000 crores. And we expect to use about 2,500 to 3,000 crores towards growth opportunities, towards land and new business. And we expect to generate around 2,000 crores or more of surplus for our capital providers, which includes debt reduction as well as dividend payback, dividend payout or equivalent to our shareholders. We, as we had mentioned earlier, we expect to have our debt between 5,000 to 6,000 crores by the end of this fiscal, and we stick to that kind of a range.
And how is the warehousing and industrial park performance going, and what kind of opportunity do you see there? What kind of top line potential?
So the warehousing platform is a separate independent business, and it would be best for the CEO of that business, Mr. Devendra Rawat, to address those specific points. Macrotech Developers Limited is a 1/3 equity owner in the business, and also is the main operating partner of that business. However, being a standalone business, it would not be prudent for me to comment on its operations. I can give you a broader picture about the fact that the warehousing opportunity in India is very large as the economy becomes more and more formal and our infrastructure improves. The warehouse platform currently has 2 projects where construction is underway, and it expects to add 3 to 4 new projects in the course of this fiscal.
Right. Abhishek, you've mentioned that revenue recognition going forward will start to reflect in the company's performance. As the improved price realization also starts reflecting, would margins also then improve from here on?
Yes, we do expect that on a like-to-like basis, margins will move up by about 100 to 200 basis points each year. I think this year, as the contribution from our joint development projects goes closer to its normalized long-term level of 40% of our total pre-sales, we'll see EBITDA levels at about 30%. We may even see similar levels in fiscal 25, but thereafter we expect to see margins move up by 100 to 200 basis points each year. And as you know, we have very limited D&A costs because we have no real significant fixed assets, and our interest costs are also falling significantly. So therefore, while we expect strong pre-sales growth of 20%, underlying EBITDA margins around the low 30s, but our PAT margins are improving consistently because of the fall in finance costs as well as the overall growth in the business, and therefore our ROEs are going to be approaching 20% on an underlying pro forma P&L basis by the end of this fiscal and then in next fiscal.
Thank you so much, Abhishek, for joining in and sharing with us your outlook. We'll take a very quick break. Be right back with the management of Indian Hotels.